Tyler, a lot of investors are looking to the oil patch for yield, and they're looking for stable dividends, some growth of that dividends, and that typically leads them into the midstream space. The companies that run the pipelines, have the storage facilities, have the import export facilities, the terminals, do a little bit of gathering, refined products, natural gas, all that stuff. These are the toll booth businesses. Two really popular ones: Enterprise Product Partners and Kinder Morgan. You ready to talk about these two? See if we can come out with which of those we prefer right now?
The way you pitched it like that, who wouldn't want to do it? Let's go.
Tyler, before we get into these two businesses, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/the smattering. Motley Fool is going to give you its 10 best stocks to buy right now. Please be sure to check that link out. It's a boring industry, but that is exactly the point. That really is. What's not boring is the yields that you can get from these businesses. Enterprise Products Partners at recent prices, 7.4% dividend yield, 6.5% yield from Kinder Morgan, round figures. That's really good. It's better even than you can get. We've talked a lot about money markets and short-term treasuries generating 5% yields. You're getting better than that. In recent years, both of these companies have demonstrated the ability to grow that payout. That's nice because interest rates, maybe they go up a little bit. I think the odds are probably they're more likely to fall or stay where they are than go higher from here in a meaningful way. So for long-term investors looking for income, I think these two both definitely pass that initial test as being worth exploring. Let's start with Enterprise Products Partners.
I guess you could say talking about these two companies, kind of splitting hairs at least, because they both operate in the same industry, right? We're talking about midstream, we're talking about moving stuff, we're talking about logistics, transportation of liquid fuel. So it means pipelines, transportation, assets, gatherings, like you said up at the top. Nothing too particularly exciting about this business. The one thing about Enterprise that's a little bit more specific, if we get into the weeds, is Enterprise focuses much of its portfolio on natural gas liquids. This is this weird place in between natural gas and crude oil. I don't want to get too technical here because it's got
We
things
can
like
dumb it down. If you've ever flicked a Bic lighter, that's isobutane. Is a big natural gas liquid, right? So those are those kind of, like you said, the in-betweens. They're really good at
ethane. Yeah,
gathering that stuff, getting it to market
yeah.
where a lot of like the Kinder Morgans of the world, they're really focused on natural gas. You have some others that are focused more on refined products, more focused on moving crude oil. So it's a niche market that they've really been able to be a real leader there.
Yeah, and the real big demand driver for these particular type of hydrocarbons is petrochemical. That's really where you see a lot of demand in the natural gas liquid space. It's where you get your ethylene, your polyethylene, things that go into making your carpets and your clothes and your kids' toys and all that stuff. Basically, if anything that's made out of,
Fertilizers, car
yeah,
tires, plastics for the
yeah,
healthcare industry. It's pretty important
like
stuff.
yeah, I would say if you're looking for a petroleum-based product, especially in the United States, because we have so much of this stuff, there's a really
Mhm.
good chance that if it's anything made with derived from hydrocarbons, it probably came from natural gas liquids if it's based in the United States. It doesn't sound like a big business, but it actually is. And in terms of moving this product and getting it to petrochemical facilities, some of which Enterprise owns. Enterprise is the largest game in town when we talk about moving this stuff. They have pipelines that go from all the major shale basins as well as some of the old legacy basins that we have had for oil and gas production in the United States for a long time. And one of the things that, as much as we could go into the kind of the nitty gritty of the differences, the thing that I have always returned to when it came to Enterprise Products Partners is they have been one of the best stewards of shareholder capital in this business for a very long time. More than 30%, I think something like 32% of all of its shares are owned by the Duncan family, the family that founded the business back in the 1980s, I believe. The trust of the family still owns a vast majority of it. And so that obviously payments, income is a big component of what they do. And also it has been a good anchor for them of just being like, we care about per share value of this business. And what we want to do is maintain this business for the long haul. We're not looking to juice profits over the short term. And they've made moves, proactive moves that you haven't seen a lot of other companies do. When before COVID hit and before this interest rate rise, they talked a lot about deleveraging and buying back debt and trying to operate within cash flows, which was not really heard of in this business. And it's little things like that that don't show up at financial statements. They don't necessarily show up when you're trying to read the tea leaves of the oil and gas market. But those are the things that if you're looking for a steady income investment that's going to probably grow over time, and in this case, pay a pretty high yield, because if you're paying a high yield, you have to be very disciplined to make sure you have enough cash coming in the door all the time. And that's why, to me, Enterprise Products Partners has been one of the best midstream investments over the long haul.
Yeah, you mentioned that dividend growth. I want to share just a quick chart right here. And this is over the past 5 years, Enterprise Products dividend has grown at a pretty decent clip. I'm going to show this on a percentage basis. It's up about 15% over the past 5 years. And you can see more recently, they've begun to accelerate their dividend growth a little bit, which is nice, because if you look over the longer term, there are periods of time where the dividend grew at a pretty slow rate, and they've begun to increase that a little bit more recently, which is nice.
That was a deliberate, proactive move by management that said, we need to free up some cash to make sure that our capital spending is covered by cash coming in the door, and we're not taking on debt, too much debt, and we're not issuing equity to do that. And that's been a fundamental change for them in the past few years. And that's where you saw that slowing of dividend. And when they got to that comfortable range, they re-accelerated dividend payments.
Yeah, and I want to share one thing with Kinder Morgan as we pivot over to talk about that company a little bit, because it might seem, if you look over the past 5 years, wow, man, they've grown that dividend a lot quicker, a lot more over the past 5 years. But part of that was a big boost back in 2019. And the reason they did that was because they were actually in the process, and they're still in the process of recovering their dividend from when they cut it in 2015. Essentially, their creditors said, look, if you want us to lend you more money, you're going to have to unlever some cash flow. They slashed their dividend, and it's still below those levels. So this really, to me, demonstrates Enterprise Products long-term, like you were talking about, that what they've done is focus on long-term sustainability of cash flows, build the business to be strong for the long term. Kinder Morgan has had missteps. It has had missteps in the past. And I think that's important, because I think by and large, a lot of those missteps, it's moved beyond them. It's learned some pretty painful lessons, and the business is sound today. They have a pretty strong investment grade, BBB, so a mid-grade investment grade balance sheet. We've seen with Enterprise Products, Kinder Morgan's paid off debt. I think their debt peaked at around $38 billion back in 2019. It's around $30 billion today. So they've addressed that concern and started to unlever their balance sheet more recently, freeing up more cash flows. Also, frankly, Tyler, we haven't talked about it, but preparing the business as they have to roll debt as it matures, they're not able to pay it off, positioning themselves for higher interest rates on debt as they have to refinance debt, something that Enterprise is going to face as well. But I think both are in pretty good position to be able to do that. Really, the thing that I want to talk about with Kinder Morgan, just really briefly, is these are companies that peers is really a better way to put it, because generally pipeline companies, these midstream companies, they really don't compete.
They're ships passing in the night more than
they are. And for a couple reasons. A big one with Kinder Morgan is that it's really focused largely on natural gas. So again, we talked about natural gas liquids for Enterprise Products. 62% of Kinder Morgan's business is tied to natural gas. Now, they deal with refined products. They deal with crude. They have terminals, again, on the coast. They have terminals. They have Jones Act tanker that they own, but they have a few terminals. They're also pretty big in 16 Jones Act tankers. So they're pretty diversified. Natural gas is the core, but it's a pretty diversified business into other segments. I believe they have more pipelines than any other U.S. owner of pipelines. More natural gas moves through their pipelines than anybody else. So they're really critical to that business. So that's good. So we lay down the basics here. Kinder Morgan has a lower yield, still trying to recover that dividend back to its prior levels from a decade ago. Slower dividend growth in the more recent term, as we've seen Enterprise Products begin to accelerate its dividend growth a little bit. Both have reasonably strong balance sheets. If you're looking at these two businesses and you're picking between the two, which do you like better?
Well, at least on the business sense, I would say I'm more partial to enterprise. I just wrote a fawning love letter to them just a minute ago. But what I would say, though, is to any individual investors, you do have to understand that they have two very different corporate structures, which is going to change the way that you're going to invest in these businesses. Enterprise products partners. Partners is the very key term here. This is a master limited partnership. It's not a common stock like you would buy. Yes, you can buy it and sell it and
Which Kinder
trade
Morgan.
it. The difference being is that as a partner, you are responsible for the taxes for this business. It's called a pass-through entity. And so instead of the business paying taxes at the corporate rate, you as one of the partners pays your portion of the taxes at your individual tax rate. And it also means that these particular investments cannot or should not be held
They can be
in.
problematic to
Yes,
own in retirement accounts. I think that's the
they
key. They can be problematic
yes, they
because of
technically can be owned,
because
but it's not a good idea.
there's a tax called UBTI that can actually result in you having to pay taxes in your retirement account. Talk to a tax expert to find out if it would apply to you and how it would apply to you. But if you buy it in a taxable account, again, you're that almost 7.5% yield, your tax effective yield is going to be more affected, maybe depending on your earnings, than that 6.5% yield that you're getting from Kinder Morgan, because it's a S corp and it's a qualified dividend, right? The majority of that dividend is going to be a qualified dividend, and then for most people that qualifies at a 15% capital gains rate. If you're paying higher than 15% on your income tax, enterprise products distribution that it pays you, the majority of it is going to be taxed as the last dollar you earned at the highest rate that you pay, your marginal tax rate. So you have to factor that in as well. Picking the businesses, I'm going to look at enterprise products, thinking about tax implications, want to own it in a retirement account maybe. I think Kinder Morgan is a solid business. It's a good yield. It's well run. The mistakes they've made in the past, I think they've learned a lot from them. I think it's just an easier one to own in a retirement account, less tax implications and complications. If you're buying it in a taxable account, I think even with those complications, I still think I would probably lean in enterprise products myself.